Bitcoin is bleeding out, and the narrative that it will replace the dollar is finally hitting a brick wall. When 95% of retail wallets see their value evaporate in a single cycle, you have to ask what is actually left. We aren't just looking at a dip, we are looking at the regulatory traps and the absolute lack of real world utility that the biggest whales in crypto refuse to acknowledge. Sit back, grab a cup of water, and let's get into the specifics. First, let's start with the most obvious and often debated point: the lack of intrinsic value. When you look at an asset like a share of stock in a company, you are buying a slice of ownership in a business that produces goods, services, or cash flow. When you buy a bond, you are lending money in exchange for a contractual promise of interest payments backed by the credit of a government or a corporation. But what are you actually buying when you purchase a coin? You are buying a digital entry in a ledger that exists on a distributed network. If you hold a bar of gold, you have a physical commodity that has been used for thousands of years in jewelry and electronics. It has properties that make it a store of value by nature, not just by agreement. Critics argue that crypto assets are essentially digital collectibles without an underlying physical or economic tether. Think about the tulip mania of the 17th century in the Netherlands. People were trading houses for single rare bulbs. The bulb had value because the market decided it had value. But when the market mood shifted, the value didn't just drop, it vanished. Without any revenue generation, profit margins, or underlying tangible assets, these coins are priced purely on speculative demand. When that demand dries up, there is no floor. There is no intrinsic utility keeping the price from hitting zero. That is the first pillar. The asset exists only as long as someone else is willing to pay more for it than you did. Now, here is where it gets more complicated, because this leads us directly to the second major issue: the catastrophic failure of the ecosystem to protect the retail investor. Have you ever wondered why the traditional financial system has such complex regulations? It is because history is littered with the bodies of people who lost everything to fraud. The Securities and Exchange Commission, or the SEC, was created following the market crash of 1929 to ensure that investors have transparent, audited information. In the crypto world, we have seen the opposite. Consider the case of the exchange known as FTX. Led by Sam Bankman-Fried, it was once valued at $32 billion. It had endorsements from professional athletes, celebrities, and even some of the most respected venture capital firms in Silicon Valley. Then, in November of 2022, it collapsed in a matter of days. It wasn't just a market downturn, it was a fundamental breakdown of trust. Client funds were being commingled with the company's hedge fund, Alameda Research. There was no board oversight, no audited financial statements, no federal deposit insurance to catch people when things went wrong. Billions of dollars in customer deposits were effectively stolen. If you are finding this breakdown helpful, hit subscribe. I drop videos like this every week to help you navigate these complex topics. That leads us to the final point, the one that makes true believers uncomfortable. This is the issue of regulatory capture and the inevitable collision with sovereign law. You see, governments do not just stand by while alternative systems threaten their monopoly on money. The entire promise of decentralized finance is to operate outside the reach of central banks and national borders. But as we have seen in recent years, this is a fantasy. In 2023, the SEC initiated aggressive litigation against major exchanges like Binance and Coinbase. They are arguing that most of these digital tokens are unregistered securities. If they succeed in proving this, the entire landscape changes overnight. Companies will have to comply with strictly enforced disclosure laws, tax reporting, and licensing requirements that essentially strip away the anonymity and the Wild West nature of the space. But wait, there is an even bigger problem hiding in plain sight. Think about the energy cost of maintaining these massive proof of work networks. At its peak, the Bitcoin network was consuming as much electricity annually as the entire country of Argentina. In a world that is obsessed with carbon footprints and sustainable energy, this is a political and environmental liability that is becoming impossible to ignore. Governments are not going to look at that energy consumption and say it is a net positive for society. They see a massive drain on the grid to facilitate high-frequency speculation. So, we have an asset with no intrinsic value, an ecosystem that has proven it cannot protect its own users from internal fraud, and a growing hostility from the global regulatory authorities that control the infrastructure of the internet. It is a perfect storm. When you strip away the technological jargon, you are left with a very high-stakes gamble where the rules can change at any moment. Let that sink in. Once you see how these pieces connect, you cannot unsee it. The bear case isn't about saying the technology itself is worthless. It is about the economic reality of how these assets are currently deployed, regulated, and valued. You might believe in the future of the blockchain, but that doesn't mean the current speculative bubble is the mechanism that will get us there. We covered the lack of underlying revenue, the systemic failure of exchange security, and the unavoidable pressure of government regulation. If you got value from this, share it with someone who is currently deciding how to allocate their savings, and subscribe so you don't miss the next deep dive into where the world is actually heading. Thanks for sticking with me until the very end. I've got something even better coming next week. You're going to want to be here for that one. The reality is that the market is always evolving, and the best way to stay safe is to be the most informed person in the room. Understanding the bear case doesn't make you a cynic, it makes you a skeptic. And in this market, skepticism is the most valuable tool you can have in your arsenal. Keep questioning, keep looking at the data, and stay smart. We will catch you in the next one.